Hi. Good afternoon, ladies and gentlemen, and welcome to another MIDF conversation, where we host a lunchtime conversation between MIDF and captains of industry and thought leaders. This is a keto lunch for the intellect. No carbs, no starch, just the good stuff, pure protein and some greens as food for thought. I'd like to welcome all our participants, the entrepreneurs, the CEOs, fund managers, and finance and business professionals, the individual investors investing their own hard-earned money, members of the media, students, especially those studying maths or economics, colleagues, and everyone. I'm delighted that we have with us today, live from the west coast of the USA, the principal of Tantallon Capital Advisors and Chief Investment Officer of Tantallon India Fund and Tantallon Asia Impact Fund, Mr. Prem Manjooran. Good afternoon, Prem, or rather good evening, and thank you so much for joining us today.
Thank you, Charon. I'm really glad to be here, and thank you for inviting me.
No, thank you. I mean, it's really kind of you to do this, late in the evening, well in the evening in your time, but it's a real honor to have you. Prem, maybe we could start just talking a little bit about how you got into investing. We spoke a bit earlier that one of the first stocks we ever bought was a Malaysian stock, but perhaps just a little bit. You grew up in India and now end up being a fund manager in the West Coast.
Serendipity, some angel on my shoulder, right? I mean, I grew up in Calcutta. I left to go to the United States to go to university when I was 18. My father and grandfather had gone to school in the UK, and I decided that since they did that, I would go somewhere else. And so I went to a small university, Davidson College in North Carolina, where I spent 4 wonderful years, and I studied economics and political science. And I had one job, basically. The Capital Group came to campus to interview, and you go through this whole slate of interviews as a 21-year-old kid, not really knowing what you want to do, what you might be good at, but assuming it was going to be a stepping stone. And I met the recruiters from Capital, and for the first time, it felt to me that there was something different. They seemed to be much more focused on me as an individual, as opposed to just going through a process of interviewing 20-year-old kids. And when I went to Los Angeles to interview with them after that, I met a range of people. And again, the interview process at Capital tends to be fairly elongated. And so 20 interviews later, I really walked away feeling like I had met a group of people that were focused on me as an individual and were committing to watching me learn and grow. And that was what was so unbelievably attractive to me as that 21-year-old kid. And so, as I said, I knew very little about the fund management business. I knew very little about how long a career was supposed to be. But it seemed to me that was an amazing opportunity to learn and to grow and be paid while you were doing that. And so that's when I went to join the Capital Group. They're a large mutual fund company based out of Los Angeles. They were the pioneer investors into the emerging markets. And so I was fortunate to be part of that process, investing in the emerging markets and learning the emerging markets from the ground level up. And that really was where the journey started. So not necessarily a lot of pre-planning. There was no internet to do all the research that you can now do sitting at your desk trying to identify what the opportunities might be. And so you were really trusting your instincts on the people and the opportunity. And I was very, very fortunate.
Gosh, amazing. Now, of course, Capital is a gigantic organization. It's now what, $2.something trillion AUM. I mean, it's a massive company.
It's $2 trillion US, much smaller when I interviewed. There were $110 billion in assets. And so 800 people at that time. It's now almost 15,000 people. So fairly dramatic organization in terms of size and scale. But the culture has stayed the same, and that's been amazing to watch and see.
And you were there at the beginning. I guess, that's real indication of just how important the whole asset management industry has become, right, to the financial markets.
Yeah, I mean, well, Capital's roots goes back to the 1920s, so it's been around a long time. But the acceleration in capital markets and the allocation to to capital markets really happened starting in the 1980s with the changes in regulations and retirement investment in the US. And it became an industry rather than small boutique shops. And so it's the Capitals, the Fidelities, the Vanguards, the Templetons. They're now household names. They were not household names in those days. And so it's been an extraordinary 30 years to see.
Gosh. And then after that, you left in 2015, was it, to Capital?
Correct. So Capital was this amazing home, and in many ways is still my home, because my best friends still are at Capital. I spent 2 stints in the office in Singapore. I was in Singapore from 94 to 99, and then again from 2005 to 2011. I decided to retire from Capital in 2014 because I wanted to do something that I could no longer do at Capital, which was investing in much smaller companies, invest in a country fund, and invest in a thematic sector regional fund. Capital is really big, broad global mandates. And so the micro mandates was just not possible. And that's where my passion sat. And my colleagues at Capital and their graciousness and generosity understood that. And so I left with an extraordinary amount of goodwill, and I left with their blessings. And so I had the opportunity to go work for a boutique and reinvent myself. So rather than working on the big ship, working for a boutique very much in startup mode, but focused narrowly on the segments that I was passionate about, India as a market and Asia as a region.
Gosh. And the name of the company is Tantallon.
Tantallon.
Tantallon. What is Tantallon? Where does that come from?
Well, so Tantallon is actually a Scottish castle. It's a ruined Scottish castle. And my colleague, Nick Harbinson, who started the firm in 2003, he is a long time investor in Asia. He ran WI Car, for a couple of decades across the region. And so he started the firm in 2003. And so when I retired from Capital, Nick had been a dear friend going back many years, asked me to join him. And so that's what I did. But that's where the roots come from. Tantallon is really that old Scottish castle that Nick fell in love with when he was a student in university. And he held that name dear to his heart.
Oh, okay. Oh, but he's not like a Scottish lord or something who owns that castle.
No, not at all. Not at all. Not at all.
Not at all. Pretty amazing, the Scottish lord. Right, okay. So let's just go. So going back to when you started investing, I mean, emerging markets, did they exist then? I mean, there's just beginning, right? To have this idea of investing in emerging markets. This is the 90s.
So again, I think Capital was very instrumental in that, because Capital was seeded by the World Bank and the IMF in 1987 to set up an emerging market fund. And the whole idea was, as the capital markets in developing markets developed, it would hasten their road to reforms and economic progress. Right. And that was the thesis. And so the Emerging Markets Growth Fund was seeded by the IMF and the World Bank in 1987. So I was very early on in that journey. And the first market that I was assigned to was Malaysia. And so I started coming to Malaysia to visit managements and companies to invest in 1991. And I'm not sure whether Sushila Menon is sitting in this crowd, but she was one of the first colleagues I met of yours in Malaysia. And so UMW was actually the first stock I ever bought.
Wow.
So, when you think about that PNB connection, it is very, very close to my heart.
Wow. I mean, I know when you went back then, there were a couple of hundred companies at the most, right, listed, and you met most of them.
Well, there were probably no more than 150 companies that were listed, and I certainly didn't see all 150 of them, but I got to know probably the top 100 companies in Malaysia really well. And the graciousness of Malaysia meant that I had the opportunity to establish relationships with CEOs and CFOs and middle managements in companies across the spectrum of Malaysia. And so that's something that I truly have valued and appreciated and keep coming back to, because when I come back to Malaysia, I feel like I get to meet a lot of friends, managements that I have met for years and years and years. And it is reassuring in some ways because they recognize my notebook and they recognize that I carry the notes from the first meeting I had with them to the most recent one. And so it gives me an ability to cross-reference and go back and refer to what they said relative to what they did. And so they joke about that notebook when it comes out because it's something that I've carried around with me since I was, an early investor in Malaysia in 1991.
And you still keep them, right? You were saying just now, you look back at your old notebooks, and that's how you knew it was you.
So now I have an iPad, but I still have the old notebooks. So they know that they still exist. So I still bring the notebooks with me when I go see these managements.
You're a legendary investor in Malaysia, right? And everyone was terrified of you because of that notebook, because they knew you're the only person who said, but you said this, 8 months ago. People were terrified of you.
Well, I tell you, I learned many lessons. And there were some good ones, there were some bad ones, right? And so you make mistakes and you have successes. But being consistent and maintaining the integrity of the process, I think is really important. Being a disciplined investor is really important because ultimately you're a steward for your client's capital. And so to the extent that you can be diligent and thoughtful and engaged and consistent with your investment approach, and the notebook helps because it anchors you to reference points and data points that you pick up in meetings and that you can go back and revisit. And data points change, and the ability to go back and reflect on what changed, what worked, what didn't work, I think is very, very powerful.
Gosh. So, when you started investing in Malaysia, Malaysia was the darling of the emerging markets, right? Everyone was rushing into Malaysia. Stock market was up. I think at one point, in turnover on Bursa, rival turnover on the Western exchanges. And then you saw, Malaysia kind of not be such a darling of emerging markets. Do you have any lessons for us? Can you see, what did you see? What happened?
I struggled in the bull markets of 93, right? I truly struggled because you were just jumping on the tail of a tiger and hoping that it didn't shake you off. My most favorite memories of Malaysia actually were anchored in the crisis of 97, 98 and capital controls. I had left a message for my colleagues reflecting on capital controls, and I must have sounded pretty down and depressed because basically Malaysia was uninvestable for a period of time. And I must have gotten, and this is when you still had voicemail messages that you would leave your colleagues. And I must have gotten back 50 voicemail messages that day from colleagues in different parts of the world because the message was the same. This is your chance to get to know Malaysia better than anybody else because for a period of time, no one will care. And actually, that is exactly what ended up happening. I was living in Singapore at that time, so coming across to Malaysia was an easy flight or a day trip or two. But you got to then spend time with CEOs and CFOs and middle management because no one else was showing up to talk to them. There were no other fund managers showing up to talk to them. And so I got to really, truly understand businesses and managements and understand how managements manage through crisis and through tough times, because the lessons they learn and internalize through those difficult times are the ones that come back to help them. And so that's probably my favorite memory, those dark days of capital controls where Malaysia was uninvestable. That's the time I got to know the managements in Malaysia the best of all.
Gosh. At the time, capital was one of the biggest foreign investors in Malaysia, weren't you?
We were very fortunate. It was coming through that experience in 97, 98 that we started to build our exposure to the markets. And so we became substantially larger investors, largely because of the lessons I learned from watching managements in crisis, because managements dealing with crisis end up making decisions that really stand them in good stead. But even before that, I had a handful of managements that I truly valued and treasured because they took the time to show me and teach me their businesses. You talked about legendary investors, but really Malaysia has legendary entrepreneurs. And, I think of several that come to mind. Tan Sri Lee at IOI is one. And, people used to call him the tree whisperer, right? But what he said to me one day in my notebooks that I've never forgotten, he said, if you're thinking about the next 10 years, plant a tree. If you're thinking 100 years ahead, educate the people. And what he did was he taught me the plantation business. He taught me the 7-year cycle. He taught me about the weather patterns that impacted rainfall in different parts of the world. He taught me why Sabah was so important to his strategy going forward. And so the fact that he took the time to explain his business, the challenges, the cyclicality, the opportunities that it created for me an education for sure on the plantation sector, but it gave me great perspective on commodities and soft commodities in particular. And so several years later, when he decided to go into Indonesia, I knew exactly what he was going to do because he'd already done that in Sabah before. So those are the lessons learned. Another of your former colleagues, Tan Sri Liu at SP Setia, right? Amazing entrepreneur. The ability to take risks, the ability to assess a project, the ability to say, I will commit risk capital and here's my downside. Again, being able to frame the downside, really powerful lessons for a young investor to learn. Here's a man putting his own money to work, but being able to say, I see this amazing opportunity, but there's significant downside. And I need to be able to balance that too. So again, those are just little data points, little snippets, if you will, but they give you a sense of the learning process we go through every single day, because ultimately management's making decisions on allocating capital are way better positioned to make those decisions than someone like me sitting in front of my spreadsheet. And so you need to respect that and understand that and learn from that.
Gosh, amazing stories. And you continued investing in Malaysia anyway, and until you that was still part of your remit.
My remit, yes.
When you left Capital. But did your feelings about Malaysia change over that time in terms of whether you be overweight or underweight Malaysia?
Yeah, of course, right? I mean, one of the first lessons I learned in Malaysia was to invest in companies where politicians simply had no interest or didn't care about.
Right.
So trying to stay away from any political interference, I think, was important. And over the next 20 years, politics became so much more important, right? And with that transition, you lost the ability to invest purely in business fundamentals because you then had to make risk assessments on political risk. Right. And those are almost impossible to get right consistent. So yes, coming through the last 20, 25 years, my feelings did change because it became much more focused on trying to assess political risk as opposed to focusing on individual companies, which is where my passion sat. And so you became less committed to the market because there was so many unfathomable that you had to assess and get a grip of.
We were talking earlier, I mean, politics is a feature of many markets, and presumably politics must be a bigger feature of emerging markets as well. So even compared to other emerging markets, you're saying that Malaysia seems more political than most. Would that be right?
I think it went through phases, right? It went through phases, and I'm preaching to the choir, right? All of you are fully aware of what has happened in Malaysia in the last 25 years. And I think there will be lessons learned from that process, right? And I think you hope you get back to the point where politicians can get out of the way and let companies do their job, right? That's, I think, ultimately the hope. And it's true in every market. I think it's clearly a risk you assess very carefully in all emerging markets, because politicians and regulators have a disproportionate role to play as you go through a process of deregulation and opening up the capital markets. But the better markets actually are a result of the politicians getting out of the way.
Gosh, that's very, well, I mean, I wouldn't disagree, but it's, yeah, that's very, very good idea. I was going to say Friedman, like, the business of business is business and business of government is government. Sorry, just a note to everyone who's watching. If you have any questions for Prem, just use the Q&A box and type them in, and we'll work through them as we run through this conversation. That's okay. Let's move away from Malaysia for a bit. I'd like to come back to it later, but let's move away from it a bit, because I think I'd like, you are a global investor now, and you have so much views on the world. Maybe could we just move to what's happening in the US and interest rates and tightening? I mean, we just I mean, we're sitting from over here, right? I mean, the world's trying to come out of the pandemic. Why is this really the best time to start tightening money supply and raising rates? I mean, I know there's some risk of inflation, but we don't want to kill off, having survived COVID, you don't want to kill off the economy through raising rates, right?
Well, I think there's clearly a balance that will be articulated, and I think the Fed has done a really good job articulating a path forward. The reality of this particular Fed and the composition of the Board of Governors and the chairman of the Fed is that they are going to be data-driven. They will not make decisions on the fly. They will not make decisions that they will reverse quickly. They will make decisions based upon the data that they see. Because that is their personality, they run the risk of reacting later than they might have otherwise. And so the fact that they're starting to articulate a tapering and the likelihood of 3 or 4 rate increases over the next 12 months is really a reflection of the data that they're seeing coming in over the last 6 months, right? Growth in the US is running ahead of most people's expectations. Unemployment is low. Wages are rising quickly, and inflationary expectations are truly as high as I've ever seen them. I was not around in the late 80s when Volcker had to tighten so dramatically. But there are clearly signs of inflationary expectations running at a level that makes every regulator and central banker uncomfortable. It's not just the headline numbers that get posted, a 5% inflation rate or a 7% inflation rate. It's inflationary expectations that are seeping into the everyday. And that's what the Fed needs to respond to. I don't think they have any intent to cut off a recovery or to kill a recovery. But I think as they focus on their priorities, which is price stability and full employment, those are their 2 mandates. It's not the markets, it's not growth, which is what most people assume. It's price stability and full employment. That's what they're going to be focused on delivering. The price stability part is crucial at this point. So I think we should expect rates to go up. I think we can all say that, if the 10-year was to be at 3% in the next 12 months, we shouldn't be surprised. And oh, by the way, it was 5% not that long ago. So you should be able to plan your life around a 3% on the 10-year.
Do you think the markets will recover, especially the tech, all these more speculative tech companies, or is that the end of them?
I think the one hopeful reality check that we've all had to internalize over the last few weeks has been that profitless growth can no longer continue to just go up, right? I mean, you've had a lot of narratives driving stock price performance post-COVID, right? The abundance of liquidity has created a randomness to valuations that make no sense at all, right? Not just the meme stocks, and from a year ago, it's the incredibly highly valued companies based on some notional total addressable market. It's equivalent, I think, in some ways to the eyeballs of the 2000s, when everyone worried about how many eyeballs were you going to measure. It has become a little silly, right? And so this is, I think, the internalization is that profitless growth is no longer going to be rewarded, right? The narrative has to be matched by execution and delivery, and by the way, profits and cash flow.
Well, many, Malaysian, well, not many, but a couple of Malaysian linked companies did try and catch this boom. Unfortunately, I think they kind of missed out. And some of these SPACs have come down in price, sometimes by 50%. But I hear what you say about profitless growth. But on the other hand, though, I don't know. I mean, maybe there is something to be said. I mean, Amazon finally made money, and when it made money, it really, really made money. So.
Well, but again, so again, we can go through the details of Amazon, but what really has driven Amazon has been Amazon Cloud, right? The investments they made in the cloud business is what's driven their profitability. It's not been the e-commerce business that you know them for.
That's right.
And so, yes, companies do reinvent themselves and do find or channel themselves towards profit drivers that are not necessarily obvious at the time. But I think money has been too freely available to a bunch of people with algorithms and spreadsheets, right? And the promise of total addressable market growth. And so this is the reality check, right? So here's your strategy, here's your algorithm. How do you convert revenue growth into cash flow? And if you can't, then maybe we need to move on, right? And so I think that's kind of the stage we're at right now.
Okay. Well, 10-year yields at 3%. You're right. I mean, you're right. 3%. It's not that high, it is, especially for 10 years. So we should get to learn how to live with it. Okay, so now we talked about a little bit about what's happening in the US. So let's go back to the emerging markets, or rather to India, which is where you're investing now. Do you see the same opportunity? Do you see the same opportunities in India which people used to see in China? Is that how you would view in India?
I think you took the words out of my mouth. I think India is where China was in the early 2000s, right? Just after joining WTO. Just as China started to deregulate, just as China started to open up its industries, just as China started to welcome foreign capital in, and welcome with an inverted commas, right? But you certainly saw a flood of money come into the market. India, I think, is at that stage. There is a singular difference. When I first started going to visit companies in China, you would meet the large state bank or the large state utility or the large state cement company or the large state telecom company. There was no private sector. There was no Alibaba. There was no Jack Ma. And that's the singular difference, because at that same point on that inflection, as India is starting to grow at a rate that is going to map what China did as it industrialized and deregulated, you have a really rich menu of private sector companies to choose from. And there is, again, another difference that I think we have to internalize. The private sector in India, generally speaking, assumes that they are not going to be bailed out. So if they get into trouble, they will go out of business. So again, unlike the Chinese investment story of the 2000s, you're not going to see reckless spending of capital, because the assumption is that I have to ultimately repay the banks. Right. No one's going to take me out. And so that creates discipline with the investment process. And now with the Modi government really prioritizing infrastructure, you have the enabling resolution now in place, so to speak, to allow industrialization to take place, to allow mass employment to take place. And so again, as I said, India is where China was in the early 2000s when it entered WTO. And the difference being you have a significantly richer menu of companies to choose from to invest in, who are going to be much more disciplined with capital allocation and investment decisions, relative to what we saw happening in China years ago.
That's really interesting. And I like this idea that, in India, if business gets in trouble, no one's going to bail them out. I mean, there's some of that, the kind of accusations leveled against some Malaysian businesses, and in the past, I think, against some of the larger, more well-connected Indian companies as well. That if you get in trouble, somehow you'll get the state bank or someone to bail you out, and it's good that people have to live.
But that was true, right?
Yeah.
That was definitely true, and there are plenty of very high-profile instances of promoters sitting in extremely lavish surroundings in London or in New York.
That's right.
With the banks in India holding their debt.
Yeah.
But I think it's a different environment today, and so I think the very clear message is: if you borrow money, we're expected to get the money back.
Okay. One of the differences with India and China, which people used to say, and I think it's still true, is that with the Chinese government, if they say something, it gets done because it's just that's how the system works there. It's very kind of command and control. Whereas India, India's a democracy, and you can't do that same kind of command and control which China can do. Do you think that's going to be a problem for India?
I think it has to do with expectations. So absolutely, India is a democracy. There are checks and balances. There will be a Supreme Court that guarantees the rights of the small investor and the small individual on the streets. There will not be control alt delete, which is unfortunately what we saw a lot happen in China as China deregulated through the 2000s. So I think there will, as a result of that check and balance, be structurally slower growth. So I am not expecting India to grow at 10 to 12%. I think India grows at 7 to 8. And I think it's a very sustainable level of growth. The other happy outcome of it being a democratic process where you have to engage with multiple stakeholders, where the court system actually ultimately will adjudicate in terms of the rights of individual shareholders and stakeholders, the reforms that are being put in place end up being more durable, right? And so the check and balance in some ways takes the powers away from the robber barons. It institutionalizes a reform process, but it does mean that the process is going to be much more elongated and much more tedious than what we became used to seeing in China. But I think as a result, the reforms end up being more durable.
No, that's the thing, isn't it? I mean, people say that, if you want to build a factory or build a road in India, it takes forever because you have to go through so many layers of, bureaucracy and checks and balances, call it what you will. But is that going to go away? Do you think things are getting is it faster? Is it easier now to build a big factory or a big road?
So I think there have been several parts of the reform journey in India that I think are very compelling. The tediousness of building a road is not going to change, right? You still have to secure right of way. You still have to move houses or apartment buildings so that you can build a new highway through, or you have to deal with the environmentalists if you have to cut through a forest area in order to build a road, or as you dredge rivers in order to create deep water ports, or when you create affluence discharge into the ocean with some of the manufacturing, absolutely the checks and balances are going to remain and will be a pain. But again, as I said, the things that have changed meaningfully, which is that the process is now fully accepted.
Right.
India is industrializing. The focus on infrastructure is real. Modi's majority in parliament over the last 9 years has allowed him to put in place the reform measures, starting with GST. We've talked about GST in India for 25 years. It took Modi coming in to actually make it happen. Did it happen perfectly? No. Was it smooth? No. Well, you remember how complicated and tough implementing GST in Malaysia was, right?
Yeah.
In a relatively small country. And when you think about a country that is 1.5 billion people, putting GST was complicated, but it happened, right? And so again, I think the process is underway. There's a transparency now to bidding for government projects because all the projects get bid for online. I had a company that I've known for years in the cement industry say to me, if I wanted to bid for 5G spectrum, I can. Because as long as I have money from the bank or investors, I will bid on an online auction for 5G spectrum. And everybody at the end of every night gets to see whose bid was placed on the spot. So there are no more licenses being handed out in brown paper bags, right? There's a transparency to the bidding process that I think is refreshing. And I think as a result, as I said, the process becomes much more durable. Banks understand who the promoters are when they're lending to the funding of those infrastructure projects. Banks have a better ability to assess capital risk, and banks have the ability and the transparency today to lend to retail investors that they didn't have before. And so again, as I said, the reform process is real, and it will move much slower than what China did, but I believe that the process will be much more durable as a result.
Yes. I mean, China's growth was largely fueled by exports, right? I mean, it became, right, the manufacturer to the world, the factory of the world. Is that the way India's going, or is it more kind of based on domestic spending? Or?
I think it'll be, India's primary engine up to this point has been the domestic economy. Domestic consumption has been the primary driver and will remain a driver. I think the China plus one framework is where India will really truly shine. And I'll give you a very clear example. The tragedy of Bhopal several years ago in India meant that India instituted regulations for their chemicals industry that were basically taken from EU standards. So the chemicals industry in India adheres to EU and US specifications in terms of environmental compliance. A permit for a new chemical plant in India takes about 5 years before that permit is approved, because you have to submit a feasibility study, including a study of groundwater effluents that might happen. As China is now cutting back its pollutive industries, the rest of the world has to find an alternative source. There's only so much work that can move to Vietnam, right? Vietnam is only as big as one Chinese province. And so as a result of that, this China plus one framework will see significant outflow of opportunities for countries like India, Indonesia, Mexico, Brazil, where you have large population pools, improving infrastructure, and management and access to capital. And so that's really an opportunity for India over the next decade. This China plus one filter will be truly internalized as India develops the infrastructure to take advantage of the opportunity.
Gosh. I mean, when I think of India and exports for the moment, you think of pharmaceuticals, that's one thing I think India seems to be very good at. And of course, tech, that's, people always think about tech. So what do you think about India tech? I mean, do you see that as a growth sector?
Yeah, so I think the pathway for Indian IT services companies remains robust, right? I think you're going to continue to see them take market share from, the likes of an Accenture and the big boys in Europe and the US. It's not any longer just labor shopping. It's not just a labor arbitrage, because you now have a pool of talent in India in size and scale that very few geographies can provide. There are 200,000 elite engineers coming out of the Indian IT services, IT colleges every single year. No other country in the world has that, right? So the run rate of critical mass of engineering talent in India will be a significant differentiator. But that low-cost engineering talent will also translate to robotics and automation and the ability to take market share away from the auto ancillaries businesses in China. People will look for low-cost engineering talent and opportunities, so the opportunity is there. So the Indian IT services will be a significant driver of exports for India. Pharmaceutical will remain a significant driver again, because there are very few pools of process chemistry talents like you do have in India today. And so that process chemistry skill set coming out of the Indian universities will again create a critical mass that allows the chemical industries and the pharmaceutical industries to be significant exporters going forward. And the third piece is good old-fashioned industrialization, where you have the opportunities from the automotive sectors in the electric vehicle value chain to the opportunities that the multinationals that have been in India for decades are seeing. So Cummins in India, or ABB in India, or Siemens in India are now using the Indian manufacturing basis to export to the rest of the world, because they are producing the same goods at a cheaper price than what they're doing in China, because China has seen wage growth in the 12 to 15% compounded average range for the last 25 years. And so as you see the multinationals focus on India as a manufacturing hub, it creates a network effect that will continue to be very powerful, driving for low cost, light engineering exports as well.
Gosh. I mean, you look at India, or just as one used to look at China, and you think of India as being this pool of low cost, low skill, perhaps semi-skilled labor. But the way the picture you're painting is very high tech skills. Lots of very cutting edge technology going on.
Well, I'm not sure you're cutting edge yet, but I think you definitely have low cost engineering talent.
Right.
And that will continue to scale over the next several years.
And of high quality, and clearly of high quality as well.
And you're not compromising on quality at all, right? And the fact that everyone speaks English, again, it is an advantage as you interact with the West in particular and the multinationals in particular, right? And so low cost English speaking engineering talent, I think, will be a significant driver.
Are there companies in India like the ones you find in Shenzhen, the DJIs or the ones who make that kind of really more cutting edge, I guess, more advanced?
Yeah, so not yet. I think the cutting edge stuff that's happening is still on the software side, right? It's yet to diversify into the other engineering talents that will come. It needs time, it needs money, it needs the infrastructure that gets to be created, and then the rest will follow. But my conviction, again, as I focus on the pool of engineering talent that graduates every year, is that it will be a significant differentiator in the years ahead.
Brilliant. Okay. Thank you. We got quite a few questions now on our question and answer box. So maybe I'll just read it. We'll just take them one by one and you see how you want to answer them. First one from CK Tan. Dear Prem, how do you see the investment opportunity in China?
It's interesting. So first of all, what we're seeing happen has happened in other countries before, right? Where the political leadership, for whatever reason, decides that they have to intervene into the business process. And the cost of risk capital in China, no question, has gone up over the last 12 months. Risk capital is scared, and domestic risk capital in particular is anxious. In that framework, there are opportunities for long-term investors. I think you just need to be patient, and you need to make sure that you understand that the companies you're investing in do not challenge or compromise the political will. Right? And I'm using the word as broadly as I can, because I'm not sure I come across too many people that can actually articulate to me what the political will actually wants. But I think there are significant opportunities. You just need to be patient. And you need to understand that if you challenge the king, you will get your head cut off.
Yes. Yeah, not wise to declare oneself smarter than everybody. Yeah. Another one from Siti Masliza. What's your best advice to a small investor who's got not a small personal income and who lives in a country that's not really politically stable?
I will just share with you what one of my old colleagues shared with me when I walked in the door my first day at work. And the person said, put away a little bit of money every month. And if you put away a little bit of money every month before you start spending, you never miss it. And so the consistency of investing is more important than how much you invest. And being able to invest consistently, whether the markets go up or down, that discipline and that consistency is truly, I think, what's been the most beneficial to me.
And would you say that person should buy a mutual fund, put it in fixed deposit?
Yeah, I mean, my bias has always been mutual funds, right? Because at the end of the day, you hope you identify a fund management firm that takes their responsibilities to their shareholders seriously and are committed to growing the wealth for their small shareholders. And so it's the most disciplined thing to do is to put a certain amount of money every month into a mutual fund or a set of mutual funds that you're comfortable with based upon your risk appetite, but to do it consistently. The consistency is more important than anything else, I think.
Good advice. Now, next question from Michael Greenall, who says, hello. What is your view of the US equity market and tapering and your view of US-China spats and investability? I think you've answered most of these questions. Anything more you want to add to this?
Michael, I was really glad to hear that you were on the call, and hopefully we can catch up soon someday, one of these days. Michael, I think interest rates are going up. I think markets will be volatile. Energy costs are unsustainably high, but it's driving inflationary expectations. And I think when you identify opportunities in beaten up SPACs or beaten up tech stocks, you really need to focus on identifying what the long-term business modes are and understand that they can actually convert revenues into cash flow.
Good, thank you. Next one is from The Edge, seeing the inevitability of inflation and supply chain disruptions. What's your view on commodities? Do you have a view on commodities?
Yeah, I think first of all, the historical linkages with inflation and interest rates seem to have broken down, and I think you just need to look at the price of gold to come to that conclusion. However, the focus on greater environmental compliance, the increased difficulty with accessing capital for investing in commodity geographies has meant that there's been a substantial decline in investment rates in a series of commodities. And therefore, I believe that the commodity price inflation that we're seeing in several commodities will stay. I am most focused on the commodities that are integral to electrification and the electric vehicle value chain. So it's copper, nickel, cobalt, lithium, rare earths. But the outlook for those, I think, will remain robust simply because of the supply constraints.
Thank you. And that brings us to actually a question which I wanted to ask. It's also been asked here on ESG. So you invest quite a bit in ESG, and ESG is environmental, obviously, social, but also it's also social and governance. So Malaysia at the moment is getting a really bad rap. Well, from not just from environment, when it comes to palm oil and what plantations do, but also social, in terms of treatment of the workforce, and the U.S. forced labor report on Malaysia child and forced labor report on Malaysia is not a very nice one, and Malaysia's been put in one of the lowest categories. So how do you see ESG? How seriously do you take ESG? Do you think that makes a difference? Because if you look at our palm oil companies, palm oil prices have gone up through the roof, but palm oil, the stock prices of the palm oil companies have not followed suit, which they used to in the past. So how do you see that? Did you see as ESG being a thing?
I think whether you call it ESG or impact investing or you're more demanding of environmental and social compliance, they all will be a real cost for corporates to bear across the world, right? When you focus on the millennials and what is important to them, the environment clearly stands out, right? Labor relations stand out. This whole issue of equity and inclusion and justice and diversity, they're all thematics that we're going to continue to hear more and more and more about. And it's no longer just coming out of the universities. It's moving from the university benches into the front pages of the Financial Times, and then, it becomes part of the political nomenclature as well. So I think as we focus on the investment opportunity, you need to be clear that you're not just focusing on companies that don't do ill. You really want to make sure that you're trying to avoid companies that extract rents in socially destructive ways, who look to maximize short-term returns at the expense of the environment, or by putting customers at risk, or by exploiting their employees or minority investors in any way. So it becomes a package for you to focus on, that in addition to holding these ESG principles dear, you need to be clear in terms of why you choose to identify and avoid investing in another subset of companies. And both parts, I think, feed together into an investment process that will be impactful over the next couple of decades.
I mean, if you're starting fresh now and trying to invest in Malaysia, would you invest in palm oil?
I would invest in a couple of companies that have long valued the environment and have demonstrated being good stewards. There are several others who have been less responsible, and I would be, and we all know who they are, and you would truly avoid them, because that's the whole point about avoiding companies that have sought rents for years, and trying to identify companies and business models where new product innovation, employee welfare, product safety, the environment is not just bullet points on a presentation. It's something that gets reviewed at the board level, that gets fed into every decision the company makes. And it is the filter that companies use to judge how successful they are.
I mean, it's right from Malaysia, and our biggest exports are palm oil and oil and gas, right? Neither of which are particularly ESG friendly. So if there is, I mean, what I hear you saying is that, even though palm oil is not that great ESG, it is still possible to have an investable palm oil company, assuming that
I'm not somebody that just puts blinkers on that says something is uninvestable or something is not touchable, right? But I think I'm not naive enough to believe that we're going to live without palm oil. I'm not naive enough to live that we're going to live without oil and gas. Hopefully you identify companies to invest in that are being responsible with their messaging and with their business activities and with how they treat the environment and how they treat their employees. And the efforts that you put in to play to secure the environment, to reduce carbon emissions, to reduce your carbon footprint as you go through the E&P process, all that I think becomes even more important in this day and age.
Yeah. Okay. No, I agree. I didn't. You're right. We can't do without hydrocarbons. We can't just simply say no more oil, no more gas. It won't work.
Yeah.
Or no more coal for that matter. No more coal for that matter. I mean, people still need coal. I mean, you can try and wean the planet off coal, but what you can't do is just tell people from tomorrow onwards you can't burn coal to produce electricity. I mean, that affects the poor much more than it affects all the guys sitting in the West who are telling us to do this. Well,
but I will say this: companies that are benefiting from this bonanza, as far as commodities are concerned, they will be held accountable in terms of how they choose to spend the profits that they're generating in this environment.
Actually, you mentioned nickel and copper. Yeah, you mentioned nickel, copper, lithium. They're not the cleanest of raw materials. No, they're not the most environmentally friendly when you take them out of the ground.
They're not, and that's absolutely the challenge, right? How do you identify companies that are being thoughtful and engaged and are committed to making sure that the environmental footprint is minimized, right? Yeah. But without the copper, nickel, cobalt, you don't have electrification. You don't have the ability to transition from carbon fuels to the electric vehicle. So it's all tied together, and it's a function of us trying to identify the companies and the investors who are doing a committed job in terms of minimizing that footprint.
Yeah, I wonder. I mean, if you've taken the all-in ESG cost of making a battery, and you wonder whether it's worth it, compared to the ESG cost of just a good old-fashioned industrial combustion engine burning petrol.
Well, yeah, again, I think I've heard so many opinions. What is not refutable is that the water levels are rising, right? So as you think about global warming, what can we do to minimize that impact? It's never going to be perfect. It's never going to suit the extremes, but can we find a middle path? I think that lets you do the best you can to minimize that carbon footprint.
Okay. Prem, we've got 2 or 3 minutes left. So perhaps can I just ask you to say a few last words, particularly to Malaysians, to say, what does Malaysia need to do to make it investable so that we can go back to where we once were in the early 90s when you first started investing and everything boomed?
I truly am not arrogant enough to believe that I have the answers, right? Because the answers have to come internally. And my hope is what I said earlier is that politicians enable transition and transformation and then get out of the way. And that's what you hope to see. You hope to identify young people, motivated, driven, committed to driving businesses. And that, I think, is what makes Malaysia investable again.
Okay, great. We have 1 minute left. So just find one question to which maybe you can answer. Actually, maybe not. Prem, listen, thank you so much for taking the time. And it's wonderful of you to give up your dinner time to be with us. And if you are in Malaysia, and when all the skies open up again and you can travel, please come and visit us here in KL.
I look forward to that. Thank you again. Thank you very, very much. I'm very, very privileged. Thank you.
Thank you. Bye. Bye.